Welcome to our video on the Bernie Madoff Ponzi scheme, one of the most significant financial scandals in history. The story of Bernie Madoff is a cautionary tale of greed, deception, and the consequences of unchecked financial fraud. Bernie Madoff was a well-respected investment advisor and stockbroker who had built a reputation as a successful and trustworthy figure in the financial industry. However, in 2008, it was revealed that Madoff had been running a Ponzi scheme for decades, defrauding thousands of investors out of billions of dollars. The scale of the fraud was unprecedented and sent shockwaves through the financial world. A Ponzi scheme is a type of investment scam in which returns are paid to existing investors from funds contributed by new investors, rather than from profit earned. Madoff's scheme was particularly large and sophisticated, and he had been able to conceal it for years. He used a strategy called split-strike conversion, which he claimed would generate consistent returns, but it was all a fraud. The Madoff Ponzi scheme had a devastating impact on its victims, including individuals, institutions, and charities. Many lost their life savings, and the scandal led to a loss of trust in the financial industry. Madoff was arrested, charged, and convicted for his crimes, and was sentenced to 150 years in prison. The Madoff Ponzi scheme serves as a reminder of the importance of transparency and integrity in the financial industry, and the need for proper oversight and regulation to protect investors. The story of Bernie Madoff is a cautionary tale of the devastating consequences of financial fraud and the importance of being vigilant and skeptical when it comes to investments. In the 1960s, Bernie Madoff began his career as a stockbroker and quickly rose to prominence in the financial industry. He established his own brokerage firm, Bernie Madoff Investment Securities, LLC, which he ran for decades. Madoff's firm focused on trading stocks and options, as well as providing investment advisory services to clients. Madoff's reputation as a successful and respected investment advisor grew over the years, and he was considered a respected figure in the industry. He was a member of several financial industry organizations and was even appointed to the board of directors of the Nasdaq Stock Exchange. He was also known for his philanthropy, supporting various charitable causes and organizations. Madoff's reputation and successful track record attracted a wide range of clients, including individuals, institutions, and charities. Many trusted Madoff with their investments, believing him to be a savvy and trustworthy advisor. He was also able to attract big names in the finance industry, who invested in his firm. However, behind the scenes, Madoff was running a massive Ponzi scheme, defrauding his clients of billions of dollars. Madoff was able to maintain his reputation and the appearance of success through the use of falsified financial statements and audits. He was able to conceal the fraud for years until the scheme ultimately collapsed in 2008. The fact that Madoff was able to maintain a facade of success and respectability for so long is a testament to his cunning and deception. He was able to fool not only his clients but also the financial industry, regulators, and even his own family members. His actions not only caused financial ruin for thousands of innocent people but also resulted in a loss of trust in the financial industry. The Madoff scandal serves as a reminder of the importance of due diligence, skepticism, and the need for proper oversight to detect and prevent financial fraud. In the early days, Madoff's investment advisory business seemed legitimate, as he was using a strategy called split-strike conversion, which he claimed would generate consistent returns. This strategy involved buying a portfolio of blue-chip stocks and then selling options on those stocks to generate additional income. However, as the business grew, Madoff stopped buying stocks and instead used the money from new investors to pay off existing ones, giving the appearance of consistent returns. In reality, Madoff was running a massive Ponzi scheme, where he used new investments to pay off existing investors instead of generating returns through legitimate investments. This allowed Madoff to maintain the illusion of steady returns and attracted even more investors to his scheme. To conceal the fraud, Madoff went to great lengths to create fake account statements, trade confirmations, and even falsified financial statements and audits. He also used a number of other tactics to conceal the fraud, such as restricting withdrawals and limiting the information available to investors. He also created a second set of books to hide the true financial status of his firm. The scale of Madoff's fraud was unprecedented, and it was able to continue for decades. However, the Ponzi scheme ultimately collapsed in 2008, when Madoff was unable to meet the withdrawal requests of his investors. The revelation of the fraud sent shockwaves through the financial world and led to a loss of trust in the industry. The Madoff Ponzi scheme came to light in December 2008, when Madoff informed his sons that his investment advisory business was a fraud and that he had lost all of his clients' money. His sons immediately contacted the authorities, and Madoff was arrested by the FBI. The news of the fraud sent shockwaves through the financial community and the general public. Many investors were devastated, as they had lost their life savings. The scale of the fraud was unprecedented, and it was revealed that Madoff had defrauded thousands of investors out of billions of dollars. The initial reactions of investors and the financial community were one of shock and disbelief. People who had trusted Madoff with their investments were left wondering how they could have been so easily deceived. The financial industry, regulators, and government officials also faced questions about how such a massive fraud could have gone undetected for so long. The government's response was swift and decisive. The Securities and Exchange Commission, SEC, launched an investigation into the fraud, and Madoff was charged with securities fraud, wire fraud, and other offenses. He was arrested by the FBI and later pleaded guilty to all charges. The Madoff scandal was a wake-up call for the financial industry, regulators, and government officials, as it exposed the lack of oversight and the need for better regulation in the financial industry. The Madoff scandal also highlighted the importance of due diligence, skepticism, and the need for proper oversight to detect and prevent financial fraud. The Madoff Ponzi scheme had a devastating impact on its victims, including individuals, institutions, and charities. Many lost their life savings, and some were left financially ruined. The emotional toll of the fraud was also significant, as many people felt betrayed and taken advantage of by Madoff. The legal proceedings against Madoff were swift and decisive. Madoff was charged with securities fraud, wire fraud, and other offenses, and he pleaded guilty to all charges. He was sentenced to 150 years in prison and ordered to forfeit $170.8 billion, the total principal amount of funds that passed through his investment advisory business. The Madoff scandal had a lasting effect on the financial industry and led to a number of regulatory reforms. The scandal exposed the lack of oversight and the need for better regulation in the financial industry. The government and regulatory agencies implemented new rules and regulations to improve transparency, oversight, and the protection of investors. The Madoff scandal also led to a loss of trust in the financial industry, and many investors became more cautious and skeptical about where they invested their money. It also served as a reminder of the importance of due diligence, skepticism, and the need for proper oversight to detect and prevent financial fraud. The Madoff scandal will be remembered as one of the most significant financial scandals in history, and it serves as a cautionary tale of the devastating consequences of financial fraud and the importance of being vigilant and skeptical when it comes to investments. The Bernie Madoff Ponzi scheme was one of the most significant financial scandals in history. Madoff, a well-respected investment advisor and stockbroker, defrauded thousands of investors out of billions of dollars through a Ponzi scheme that he had been running for decades. The scale of the fraud was unprecedented, and it had a devastating impact on Madoff's victims, including individuals, institutions, and charities. The Madoff scandal serves as a reminder of the importance of transparency and integrity in the financial industry. Madoff was able to deceive his clients and the financial community by hiding the true financial status of his firm and creating fake financial statements and audits. It also highlights the need for proper oversight and regulation to protect investors and detect and prevent financial fraud. The Madoff scandal also had a lasting effect on the financial industry, leading to a number of regulatory reforms and a loss of trust in the industry. The government and regulatory agencies implemented new rules and regulations to improve transparency, oversight, and the protection of investors. The story of Bernie Madoff is a cautionary tale of the devastating consequences of financial fraud and the importance of being vigilant and skeptical when it comes to investments. The Madoff scandal serves as a reminder of the need for proper oversight, due diligence, and skepticism to ensure the integrity of the financial industry and protect investors.